yeah, so to learn from Paul's experience, and now with him working with African entrepreneurs, supporting them, and the fund, of course, is also investing in businesses, which is quite important. And Onyeka, who is about to join us, he's finishing off his very important meeting at the moment. I'm not sure if it's with a potential investor, but he's known as one of the leaders in, as a founder, creating the investment environment and successfully raising. In fact, they raised $2 million in 2017 and was recognized for that through his business Farmcrowdy. He's CEO and founder of Farmcrowdy, which is commonly referred to as Nigeria's first digital agricultural platform. So it's kind of creating a new, they were creating a new online category of business, which is not easy, and servicing about 50,000 small-scale farmers in Nigeria. So having quite a footprint in the reach of that business too. Looking forward to learn from him about the perspective of the founder in the do's and don'ts of dealing with investors, the practical experience too. So Alex is in the room with us, myself, I'm Christoph, and Paige, the administrator at the HPIP, is also with us in the room. Welcome to all of you guys in the panel, and then also the attendees. I see we've risen to over 21 attendees and 5 panelists, so with 26 people in the room now, which is kind of the nice shape to have, because then we can have a discussion too. So thanks, Dominique, for commenting there. Familiar names, Jacques, and so on too. Range of places that we come from, sort of so. But the common thing here is that we are founders that are raising, and we want we are going to, or are busy negotiating with potential investors, and we can make mistakes in doing so, or we can learn from what others have done, and that is what we're setting out to do here today. So can I ask, so most of us have opened the text chat. If you can just type in there what kind of dealings you've had. Are you new to this whole idea of raising funds? Have you raised the first round of investment? Are you busy negotiating right now? Have you gone through due diligence? What experience have you had with your business, or perhaps in working with others? Just for us to get a sense of where people are at in relation to raising funds. So Laura has gone through due diligence and applied a few times. Well, so it would be interesting to see where you had the success, Laura, and what have prevented you from having success in others. Jacques has received term sheets. Okay, so term sheets means that you kind of fairly far into it and now entering DD. So there are definitely some things that you will be able to gain, Jacques, from our discussion here today. Joshua's tried to raise through a SAFE. I'm not quite sure what the SAFE is, but we'll hear more about that from you, Joshua, later, hopefully. So Femi is raising and still raising. So it looks like there's kind of engagement around raising, some of us a bit further than others. But let's start look at what it is that we can learn from people that have been around. So I want to introduce Paul. I've introduced him, in fact, before, but I want to ask him to switch on his camera and his sound so that we can get into the substance of what we want to talk about here. Good morning, Paul.
Good morning.
Always nice to have you here speaking to entrepreneurs. I know you speak on an individual basis to many, many more, but here we've got a whole group of people together.
Good. Thanks for the introduction, Christoph. Just to add, I was on both sides of the equation, which means that for many years, I have been begging for money on one side. And on the other side, I owned myself, together with a partner, two venture capital funds for about $355 million US. And one of the funds we brought public on the European Nasdaq at that time. Okay, but let's perhaps start with the presentation. Christoph, if you could put up the presentation. Okay, next slide. Hello, Christoph. Good. Just as an introduction, it's not an academic course and discussion. It's just simple and practical stuff. Yeah, it's based on my experience and the experience of the many people that I dealt with. It's the do's and the don't do's go together, and I will say it many times and just actually get it in our heads now. It's what I call the 6-month rule. From start towards the end, you have to count on something like 6 months. If you do it earlier, that's fantastic, but it always takes more time than you think. So for planning, if you're getting out of money, please keep this in mind, that you start the process as soon as possible. Yeah. And it's based, the whole process is based on many sites, and you will hear it throughout my presentation on research. It's 3 things: research, research, and research. Yeah. And for me, the preferred outcome of this presentation is actually being prepared for your next round of fundraising. And yes, we plan to have half an hour, but it will take a bit more, because so many things we have to keep in mind when negotiating with venture capitalists. The first thing you have to do is define what industry are you in, yeah, or are you actually on the edge of multiple industries, yeah. And don't look just around the church tower. I mean, if you look for venture capital or for financing in your own city or even your own country, just go much farther, yeah. The best thing would be, if you have an idea or concept that you want to bring to market, yeah, is actually see if your idea has the potential to go to a global market, or at least a Pan-African market, yeah, for your products and services. Yeah. And again, do lots and lots of research to find your matching partner. And there are several research methods to find venture capital partners. And look in your industry who actually was capitalized and with what parties. Yeah. So, and then look up those parties that invested in similar businesses. Yeah. In the industry. Find as many companies as possible. Yeah. And look up their investors. Look them up, do research on them, and look at their LinkedIn profiles, look at their websites, etc., etc. Next slide, please. Another way is of also try to find lists of industry investors. Yeah, there are many lists available. Some are you have to pay for, and if you have to pay for it, it's quite a bit of money sometimes. Don't do it. Look for a free list. Like if you look for some lists in Europe, you know, there are some free lists available on the website of the European Community, and we can point you to some other lists. Yeah. Some investors are actually not specializing in an industry, especially in Africa. Many are sector agnostic, and they might just be as interested in your startup if the investment criteria is a match with what you want to do. Next slide. You have to do your own due diligence on potential investors before you contact them. Look up their investment criteria. Yeah. What is the size of their fund? It could be that's a very small fund, or it could be that it's a fund with decent amount of money in it. In Europe, yeah, 70-80 million euros is something like a smaller fund. In the US, a small fund is a couple of $100 million dollars. It's all different. You can have also funds that do not have that much money, but are partnering up with other funds. Yeah. So we are in that same position with the HMAP. It's not a big fund, but we have lots of partners who co-invest with us, and that's important to do some research on. When you look at the websites of investors, yeah, research who the decision makers are. Yeah, you can see it, the roles in that team, who is deciding, who is heading the investment committee, because a fund has different committees, and the most important one is the investment committee. Look up who is actually head of the investment committee. Yeah, look up those guys or ladies' profiles, CV on LinkedIn, etc., etc. An important element is also the size of their tickets. Yeah, do they invest like 50,000 euros or dollars, or do they invest like 100, 200,000, or they just start at $1 million, etc. It all depends on how much money you are looking for yourself. Yeah, are they big enough or networked enough to do a follow-on investment? If it's a very small fund, usually it's difficult for them to follow in the next round. Yeah. So also in your business plan, keep in mind that you need to put some milestones in, so you know when the next round is coming. Yeah. And as I put here on the slide, drop hints into the negotiations. You've done your homework. Yeah. And asking some so-called smart questions. Don't overdo it. But it's always good to let them know that you're professional, that you look them up, and that you know who you're dealing with. Yeah. Important to know is that they invest in complementary businesses who might make potential clients, perhaps, or even in competing businesses. If they invested in competing businesses, that could be quite a difficult one, which means that don't contact them then. It could also be, if you do your research right, that they invested in multiple businesses in the same industry, competing businesses. That means that they're hedging, which is a good sign. If they invest like in, I've done some research to help somebody in that is in the HR business. Well, there are some funds in the US that invested in 3-4 competing businesses. Then it's fine actually to contact them, but ask them why they hedge their bets and why. Yeah. Next slide. Good. There are some preconditions before you start contacting potential investors. Never start before you have a solid team together. That's one of the first things as a venture capitalist I always looked at. You know, what is the team, and what are the skills of the team? We even, in some cases, test, you know, do a kind of psychological test of team members to see if they really have the talents they claim to have. Yeah. If it's a one-man or one-woman show, it will seldom get off the ground with investors. Yeah. Another thing, and I had it several times, that companies where I wanted to invest in presented or had ready a nitty-gritty detailed rollout plan, and that's a major plus, because then actually you're fully prepared for the what-if questions. Yeah. Include your team in building your rollout plan, and then we come to the pitch deck. The pitch deck is your signboard. Yeah, I'll get to the pitch deck later on, but get it ready in a top professional way before contacting some investors. Yeah, have your financial plan ready. Yeah, we've discussed this in a previous masterclass in broad strokes, and perhaps we can have a more detailed masterclass as the next one to discuss how you should actually create and build your own financial plan. There are a couple of things, and it's worth spending like half an hour to an hour discussing how a financial plan. This is, for me, financial plan is the moment of truth. Yeah. I've also, before you start, a Q&A ready. Yeah, the positives and the negatives. Yeah, so whatever question they could ask, put it on paper and discuss it with your team, because your team actually will be interrogated once an investor does his own due diligence. Yeah. Look at your social media presence. It's a major plus, because then actually people, potential investors, can do some research on it. Yeah. Next slide. Good. Have also a comprehensive list of potential investors with contact data of decision makers. So you can actually do kind of an email burst to contact all of them. Yeah. And then after an introductory email, just call them up, try to call up the decision makers. Yeah. Another thing that you could do that we had several times, do a personality test, and you get it on paper. We have somebody that does that. The website is on the slides, and just forward it yourselves, or put it in the data room. Yeah, in the due diligence data room. Yeah. There's one thing in your own, and we discussed that lightly the last masterclass. If you have a big investor pool already, that's that could be a big difficulty and a put off for potential investors, because they don't like to have too many people in the kitchen. Yeah, there are ways to avoid that. You can pool them in a separate company. So investors only have to talk with one representative of that company. Or you can actually discuss with your current investors a buyout agreement once the money comes in. Investors usually don't like to buy out other investors, but if it's small amounts, that could not be that big of a problem. Have also a corporate governance plan ready, because that's perhaps another topic, corporate governance, for one of our next presentations, masterclasses, because that is key. People want to have access to anything and everything of the company. They don't want to have day-to-day contact, but give them actually access at least to your accounting. If you have an accounting system that is in the clouds, and which is preferable, give your new investors permissions to access the accounting, so they can actually follow it day by day. Yeah. Then last thing, if you are in a business that has lots of competition already, that's something that could be quite difficult for new investors, but you might have that much USPs and disruptive models to invest in it. So be ready for that kind of question. Why should I invest in you? Yeah. And not invest in all the others that are already on the market. What are your unique selling points? Next slide. Good. Contact. When can we contact investors? When and how? Yeah. Do you contact potential investors? Do that only when preconditions are met. Don't start too late. Again, keep in mind the 6-month rule. Yeah, be prepared. Yeah, that it could take 6 months. So do not run out of money while you are negotiating, because venture capitalists, smell it from miles away when you're desperate. So valuation goes down, then they feel you're in a hurry. Even when they are very interested in your business, they actually will discuss you down. As I put here, be lightning fast in sending documents and everything investors require. If they ask for something, you should be ready to send it the minute after it. Yeah. And if you don't have it, just tell them and give them a timing when you could provide it with them, and do it as soon as possible, because that's reacting time. Yeah, is essential to see that you are professional, that you're anticipating on the discussions, and that gives them a lot of confidence if you can answer right away. Yeah. Then one of the major things is don't negotiate with one investor alone. Yeah, do it in parallel with multiple VCs. Yeah, and if possible, try to close with at least 2 of them by splitting the deal between them, if that at all is possible. I mean, I had it before when I was setting up the biggest company where I was a major shareholder in and a founder, LNH. We went up, as Christophe said, we quoted that company later on the Nasdaq, market cap $8 billion. We had something like 8,200 people in it, big thing. But before we started, we started it with 2 people. Yeah, every company with global potential, can do that. I mean, growing that high, that big. Yeah, if you prepare very well, and if you have also matching shareholders. And shareholders is not one, if possible, have at least 2 venture capitalists that can follow in later rounds. Yeah, we had in that company I was just describing, we had something we negotiated with 6 or 7 venture capitalists, and then we retained 3 of them. So the investment was at that time 70 million Belgian francs, but that was before the euro was there, but it's comparable to something like 2 million euros. And we split that whole deal, yeah, between 3 investors. And that was actually the good thing to do. When we had a discussion, we anticipated in the board, we discussed with people before the board meetings, etc. So we could actually follow the right course. Yeah, next slide. Good. And as I said before, the pitch deck, yeah, is one of the most important documents in the phase you are. Yeah, you can give the right impression, or you can give the totally wrong impression. Yeah, you're in or out on a pitch deck. We receive at the HWAP lots and lots and lots of pitch decks. So it's kind of a sifting exercise. Who will we spend time on? And that sifting exercise is done on what? On the pitch deck, which means that some pitch decks we even never touch. You look at it, you say, no, that's not what we're looking for, or that's not professional enough. And then actually we send a nice mail, thanks for contacting us and good luck. Yeah. So spend lots of time on it and do it with a really, really professional layout. Yeah. And make it lively with pictures, short video clips that sells way more than having 100 slides. Yeah. Keep it simple, not 50 slides. I've seen it. I've seen pitch decks with 50, 60 slides. That's impossible to have a presentation with that much text in, and we see slides then with 10, 20 lines on it, with small letters. Don't do that. Focus on the financials. Your quality deck needs to be also in the hands of the right contacts. Don't put it in the hands of the chairman of the venture capitalist. Contact actually, if possible, the head of the investment committee. It's important to do research before that, and then actually we go next slide to what I call the critical 10. So minimally, you have to have on your pitch deck the company, the vision, What's the problem and what's the solution to that problem? Yeah. What is the opportunity for an investor, yeah, with potential returns? What is actually the product or service? And then very, very important, as I said, that's one of the first things I'm always looking at, the team. Yeah. What's the revenue model? We will come back to that. Yeah. And what is your competition? Know your own competition. That's again research. Yeah. And then the financials, not of course the whole financial plan, but the headlines of the financials, and then what are you asking for? Yeah, for how much money and what percentage of the business you want to sell for that kind of money. Next slide. So what really counts is the right business model. One-shot sales versus recurring revenue model. I actually in my life never invested in one-shot sales businesses, yeah, like real estate, for example, or whatever, that people have to restart every time. It really needs to be a fantastic business opportunity before we would invest in something like a one-shot sales company. Yeah, recurring revenue, and the higher, the more the revenues are recurring, yeah, the higher the valuations are. Yeah, we are, and we had that last seminar about valuation of companies. Yeah. We actually calculate the value with a DCF formula. We calculate the value based on the EBITDA you're projecting. Yeah. So if it's not that much recurring, then you have valuation between 3 and 5 times EBITDA. When it's really recurring business, that's between 5 and 10 times EBITDA. So that can make a huge difference in valuations in your negotiations. Yeah. Again, research. You know, do lots and lots of market research in your target markets. A very big plus is if you have video clips of live interviews. Yeah, you're doing with clients or potential clients. Yeah. In venture capital, that's one adagium that is counting. That's one major thing. You know, venture capital is high risk. That means we're looking as a venture capitalist for high yield. That means actually, as a venture capitalist, you're not looking at over 5 years or after 5 years to make 2 or 3 times the money you put in. You're looking at least 10 to 20 times, you know, because venture capital is a risky business, and that means that you need to cover the losses you're making, yeah, with a couple of your investments that make it like sometimes 100 times the money you're putting in. And there are many, many examples of that. So that's the way you try to present to investors that you actually are that ideal candidate, yeah, that really will be in your industry at the top. Yeah. Different examples of business models, of course, you know, subscription based. Is it a platform? Do you go on freemium, franchise, retailer, distributor? Are you a manufacturer? Yeah, which as a venture capitalist, I seldomly invested in. Yeah, are you in direct sales, etc., etc. So think, do some homework on a huge homework on the right business model. For me, they always talk about disruptive products. Yeah, for me, it's rather disruptive business models above disruptive products, like Airbnb, for example, is a disruptive business model. Yeah, Uber was the same thing, etc., etc. Next slide. Good. I want to introduce to you the concept of TAM, SAM, and SOM. Yeah. If you make up your financial plan, which might be the subject of another masterclass, yeah, is a total addressable market. Yeah, the entire potential market, independently from your ability to serve it. Yeah, the SAM is actually the serviceable addressable market. That's actually what you could actually serve and reach with your business, but that doesn't mean you're able to serve it. That's the sum. That's the serviceable, obtainable market. That's the share and portion of the market that you can capture. Yeah. Do your own calculations on that. Calculate it down the sum and then the percentage you're able to serve. Next slide. Yeah. Of course, as I said it already a couple of times, it's the moment of truth is your financial plan. Everything starts with a believable top line. And top line is sales in accounting. Yeah, that's the first line on your P&L. Again, that is the most important thing in your financial plan. It needs to be believable. It's always a hockey stick, but don't make the hockey stick too steep. Valuation, of course, include, at least for your own exercise, your own valuation. We discussed a method of valuation in the earlier masterclass, and on this presentation, you have actually the URL of YouTube of that masterclass. Using your research, a couple of websites that can, in different countries and markets, can give you lots and lots of insights and data. And Numbeo is one of the major ones, yeah. And I use quite a bit also the CIA website, believe it or not, for geographical research. Yeah. One thing I'm looking always in a financial plan, if some investees are putting expensive cars, leasing of expensive cars in their capex, for me it's out. When they make lots and lots of money, I don't have a problem with that, but not in a startup. I've seen it. I had a guy that I knew quite well, even, that put one of the top of the bill Volvos in his capex, and believe me or not, I never invested in him. Even I knew the guy quite well. Yeah. Same with salaries. Put in a modest salary to start with, going up on reaching milestones or KPIs. Yeah. Next slide. Clearly, look at your markets. I have said before, market research is key. That's actually the steel in the foundation of your plan. Clearly define the markets you're addressing in a matrix, geographical per country, and vertical, what I call the vertical market segments that you're covering. Calculate your TAM and then a modest percentage on your SAM, and spread the hockey stick over 5 years to reach the ultimate sum that you calculated. I think one of the nice things of organizing one of the next seminars to have a good financial plan is give you some hints and methods you can use to calculate all that. Next slide. Good, thanks. Due diligence, when you get that far, of course, when potential investors are reaching the due diligence phase, you have lots of chance then to get their investment. But it can break off, when they find something in the due diligence that they don't like, or you're not transparent enough, or that, even worse, if they catch you on a lie, you're out. So surviving in due diligence is key. That's actually what I call the dead valley. You need to get over that dead valley by being very professional. It's always better to under-promise and over-deliver. And that, for me, that plays for a convertible, which we discussed the last seminar. Convertible is actually you decide on a valuation based on your figures, and then converts later on from a kind of preferential stock into common stock later on if you perform. If you perform even better, yeah, you actually get a higher valuation. If you perform worse than you promised, you know, you get a lower valuation, but that's a win-win. I mean, that gives the confidence to an investor that you really believe in your plan. Yeah. Also know your facts. Eh? I mean, if people interrogate you over the things you've put on paper, you know it. You know, don't. It's killing when they ask you something that is already on paper and that they got already, and you cannot answer the question. Yeah. If possible, invite investors at your own place. It's benefits of a home match. Yeah. Plan carefully the whole timing with them. Don't let timing slip, because it's you know, the closer you come to a closing, yeah, the more urgent it comes to get financing. Set up like a Dropbox folder with subfolders or whatever online cloud means you're using, in what I call a virtual data room. In the past, when I was begging for money, it was literally a data room. It was a room you invited investors in with all the documents, contracts, whatever you had, CVs of your team, etc. All the things you can imagine that they will ask you. Put that, we were putting that in that at that time because Dropbox didn't exist then, and cloud storage didn't exist at that time. But now you can just put it virtually and put in anything and everything you can think of that could be useful for an investor. Better more than less. Yeah. And one of the things, of course, be patient. I mean, don't push them too hard. Yeah. But if they slip too much in timing, just, you know, then push a bit more. Keep your entire team up to speed. I mean, if they come to your place and they start interrogating your team and they're not up to speed on things that concern their job, yeah, it's killing. One plus is, of course, if you can provide them with some references, clients, potential clients, your people, important people out of your network, etc. Find out on their side, you know, who is in charge of the process, because then actually you can keep track of their progress. You can call up and ask for what is happening if it takes too long. And then, as I said before, never ever make things up. Rather admit you don't have the answer right away. I had it a couple of times in my life where I catch somebody that made things up and it was not correct later on and they were out. Yeah, next slide. Good. The deal structure, as I said, power of convertibles, I just explained that. Yeah. I won't go over it again, but try to keep at least 51% of equity or more. And if you're close to losing the 51% control, yeah, you can do it in two-level structure. Have a holding company where you sell a stake in that has at least 51% of the working company. So it's a bit complex, but then you keep control. If you have 51 or 51%, which is indirectly you own 25%, but still you are in control. As I said, don't overpromise, yeah, but overperform, yeah. With one thing in mind, if later on you have what they call a down round, which means that it's a lower valuation than the earlier round, that's actually killing your future rounds. Yeah. Convertible we talked about, and we can have a separate seminar how to structure that kind of deals. Yeah. Next slide. And then, of course, then the last thing is actually, I call it pick your fight, yeah, the shareholders agreement. Yeah. read and analyze every single letter, dot and comma of your shareholders agreement, and have your own ready and signed by your current shareholders, because that's a good start. That shows them what is important to you. One of the things to discuss with your investors is actually the method of the next for the valuation of the next round. How much times EBITDA, etc. Why to negotiate that? Yeah. Because if they have the potential to do follow-ons, you know, later on, because they have so much insights in the company, they can negotiate you down for the next round. Yeah, and thus discuss also the exit criteria and potential candidates for an exit. And venture capital and the venture capitalist, it's all about looking for an exit after 4 to 5 years. Yeah. The exit cycles are getting, certainly in technology, are getting shorter and shorter. Yeah. Discuss also the metrics for future board meetings, the KPIs, etc. Could negotiate your salary and the evolution based on performance, as we just said before. Also, one thing to keep in mind, you know, in the shareholders agreement, if there's a change of control, you're negotiating with people on the other side, with potential investors, and that's actually called the management company. That's the company that manages the fund. Yeah, if there is a change of control, that can have some consequences, because you will deal with other people that you might not trust and might not like. Yeah? And the same thing as an investee. Yeah? Look at that, as I just said, the two-level strategy, so you can actually prove to them that you will stay in charge yourself, which is important for an investor. An investor, if the investee, the company that is looking for money, if they are getting lower than 51%, you know, that might diminish the motivation to go ahead with the venture. And it's all about people. You're investing in businesses, yes, but you're investing even more in people and trust. Next slide. And then post-closing, of course, you will have a new board. Keep in mind, the power in a company is the board, which means you need to have majority in your board, and put that in your MOI up front, in the memorandum of installation. What we call here in Europe the bylaws, memorandum of incorporation, rather. Keep your investors during boards updated. Give them access, as I said a couple of times, to cloud-based accounting. Have 2 monthly meetings in between. If you have a quarterly board meeting, it could be that investors ask for a monthly board meeting. Well, accept that, because they can provide you lots of advice and network. And pre-agree in the first board meeting on a template of next board meetings. It's important to know what they are looking for each time in a board meeting. And the moment you close with them, the moment you close with an investor, start actually preparing for your next investment round right away. Mold also your board reporting around milestones, the key metrics, the KPIs. And one last thing, if you don't feel okay with the proposed board members, and have before your first board, have a meal with the board member or board members they're presenting, so you know actually who you're dealing with, if you like them or not. If you don't feel okay, say so. Of course, past closing, but say so. And ask them to put somebody different in front of you as a board member. Next slide. And then the last thing, we can support you if you want for further personalized coaching and mentoring and making connections with GPs, with venture capital companies, management companies. If you want us to help you there, contact Paige. Her email address is on this slide. We even are willing to sit on a board to give some confidence in the for your next round. That's just things we can help. Just let us know if you want some support or a board membership. Next slide. And that's about it. Yeah, thank you very much for being on this seminar. It's a great honor to me. Thanks to you. Up to you, Christophe.
Paul, we won't let you go so easily. So after that mouthful, you're going to stay on. So we have quite a few questions coming in. By the way, if you have a question, you can note it down by clicking the Q&A button. Some of us have already. Tandai, Israel, Nicolette have, well, that would be Nikki, as I know her, have noted some questions there already. So please put your questions there. We're going to have some time to address questions just now. We have Onyeka in the room. I'm going to ask Alex to introduce him just now. But before we do so, can you note down in the text chat what you have experienced as challenges in your dealings with potential investors? So from your practical perspective, from your experience, where you are now, and we saw quite a few of you noting already in the text chat that you're in the middle of a DD, some of you, some are just at the research stage of trying to identify potential investors in that whole range, sort of what are the challenges that you've faced? What are the problems that you've encountered? Some of it is already in the questions, but maybe you can just put in the chat there so that we can get a sense. And Alex is going to, when we get to the end of it, give us a summary of what we've experienced there, what we saw there. But thanks, Paul. That's a big mouthful. By the way, we are recording this webinar, so we'll share the link if you want to rewatch that, because I think it's so rich that you actually have to rewatch it to get the full value. What I got from it is that it starts with research, and that word research has been used quite a few times, but then it goes into organizing yourself and the information that you have into showing up in the right way, whether that's in your engagements with investors, or it is organizing your data room, or in the pitch deck that you create. And then, of course, the execute part is, sort of the post-investment side of things, which you also need to keep in mind. So, Paul, thank you very much for that introduction. But may I ask that participants, so we've got quite a few in the room. We've got a total of 32 people in the room. And I'm sure some of you have had good experiences. We will hear from Onyeka just now from his experience of raising for his startup in the Nigerian agricultural sector for that business. But all of us have been around a bit. So Emil is saying linking investor ROI with organization's social impact. Okay, so there's the focus of the business, not only as a commercial entity, but also one that makes a difference in the world, and how those align. And Tonada saying, for me, it was the investor that had so much information of the sector as a whole, but could not give room to understand the problem of a particular element of the sector. So perhaps the investor sees the big picture, and you're focusing on something specific that you battle for them to see. Some of us have asked if there are lists of potential investors that we can contact. I see Laura's saying the biggest challenge I have experienced is the difference between a true startup and a small business. Is it worth seeking investment as a true startup, or wait until you're a small business? So I'm not sure if I fully understand that challenge, but of course, we are busy creating businesses that should not be raising money forever. So, I mean, if you're building a startup that's going to keep raising money, you may, in fact, not be able to raise it because your model may not be sustainable. So I'm not sure if that's what you're referring to. But please keep putting some of them there. Yeah, so, and you saw Paul's offer there. We've put Paige's email address there in the chat if you want to make contact with Paige regarding support that may be offered to you there from the HWIP side. So, Alex, if I can ask you to switch your camera on as well as Onyeka. Onyeka's camera is on, so maybe you can unmute yourself. And Alex, if you can also come into the pictures.
Yeah.
Hi, Onyeka, welcome. Great to have you here.
Much. Thank you. Thanks a lot. Thanks for having me.
Let's just see if Alex is there to do the introduction. You can switch your camera on too, please, Alex.
It's not allowing me to switch it on. It says you stopped it.
Oh gosh, no, that was awful. Eh? Let's get your video on so you can do the introduction for us. Thank you.
Thank you. Hi, thank you, Christoph. Thank you, Onyeka, for joining us today. I understand that you were busy in a meeting with, I think, some potential investors. So thank you for taking out the time today. We've had a very insightful first half of this masterclass with Pol, who's shared some insights. For me, the major takeaway is to be very well prepared, and like Christoph said, to do your research and come well prepared with your slides. Have to be very clear. You have to know background information about the investors that you're meeting with. So there was a lot of insights. Now in the second half of this masterclass, I think I want to hear from you as a startup who has raised investment. If you could share with us today about your experiences, what you would say the do's and don'ts are when you're negotiating with investors. So great to have your perspective on this in the second half of this masterclass.
Okay, thank you very much for having me. I hope everyone can hear me clearly though.
Yeah, we can.
Okay, fantastic. So I've spent some time. So my name is Onyeka Akumah, and I'm founder and CEO of Farmcrowdy. Farmcrowdy is a digital agriculture platform that connects small-scale farmers with investors for the purpose of boosting food production in the country. And the last 2.5 years, we've raised $2.3 million in funding, both as grants and as equity funding in our business through convertible notes. We've also been able to generate about $13 million through our platform to work with, to engage about 25,000 farmers within the last 2 years in the country. Now, that was my elevator pitch. And it's very important for us as entrepreneurs to always have that thing that you call the hook of an elevator pitch that you push out to people, and immediately they hear some very interesting numbers. As an investor, they want to listen. I think I learned this very early on, and so every time I have the opportunity to speak to entrepreneurs, I start with my elevator pitch, and that, for me, gets the attention of the people I'm talking with. Now, getting into this conversation, I find it very, very fulfilling speaking to all the entrepreneurs that are on this video about what I've learned. If you, on a part of my slide, I can't remember what part of it is, but I have pitched, I was in the process of raising funding. So I'm going to speak with stories. And so the stories for me, I think they would stay better with entrepreneurs that are listening to me than all the theories. I will use the stories through my slides and tell you the examples of the things I've had to deal with in raising funding, and then they become the do's and don'ts of what the stories will be. So if you move to the next slide, it says research and plan. Research and plan, be prepared in advance. I heard Alexandra saying the same thing. You cannot overemphasize, you got to do your research and plan. Now, let me tell you my own journey. I started out saying I wanted to raise some funding for Farmcrowdy. So I'm going to use Farmcrowdy as case point. And we're going to raise some money. And in the process of doing so, I started pitching to a couple of investors. And they started saying to me, we don't think you have the right team. We don't think you have the right experience. What they were really saying to me is I didn't have traction to show that we could prove that that model will work. And so in doing my research, I later on discovered in hindsight that I was pitching to the wrong investors because they weren't even interested in the sector that I was getting into. But I didn't know much about that. So I just kept on pitching and pitching and pitching. And then eventually we raised below 100, raised the first $60,000 that allowed us to just get going. by the time I got into the US and said I wanted to pitch to a couple of investors, I didn't set out to go out there and pitch to 90 investors, but eventually I pitched to 90 investors. And it was a very, very interesting process. It was gruesome, it was annoying, it was frustrating. If I didn't have a team to back me with the work that was going on in the company, maybe I would have put the company on hold for that period while pitching to these investors. And so later on, I then learned that there are some things you need to do. First, as an entrepreneur, you need to have what I call your investor funnel. And in doing your research around who your investors are going to be with your investor funnel, you will check what sectors. Number one is you check what sectors have, or sectors of markets have these investors invested in the past. You list out these investors, and then you start looking at, so investor A, let's call investor A, investor XY. Investor XY has done, I'm using Farmcrowdy now, has done investments in agri-tech and has done investments in fintech. But investor A has also a managing partner that sits in San Francisco, but they have an associate that sits in South Africa. The associate in South Africa is more important to you as an entrepreneur in Africa than reaching out to the managing partner in San Francisco. The second thing you want to know is investor XY has done their investment in a couple of sectors, but beyond that, they have done it in maybe Southern Africa and haven't done anything in Northern Africa or in Nigeria or in Western Africa. You got to take note of those points. Investor A also, are they looking at diversifying their investment beyond their core area of focus? One of the things you need to know is, where does this investor put more money into? The other thing is that you need to understand what is the maximum and the minimum ticket size, which range of investments do they do. So we have the Series A, Series B, the seed funding, the angel investors. Where do they likely play at? What is their risk appetite? Do they come in very early or do they come in late? Because they may be interested in your sector, but their ticket size starts from $5 million. And all you're looking for is $100,000. All you're looking for is $500,000. As much as every other thing fits, if the ticket size doesn't fit your bill, they are not the investor for you now. The other thing is, I forgot to put here, which is point 4, with the investor will do your research, is when last did this investor do a deal, to understand how active are they today and whether they are the ones you should be talking to right now in your priority list. So I had a list of 500 investors that I streamlined down to 100. I pitched to 90. And okay, so one other thing again was, in the 90, I needed to have a touch point. Cold calls don't necessarily work with investors. You need somebody that is a reference point that will help you open the door to meet the investor. So I did the 90 pitches, but the ones that eventually at least responded to us, 15 of them that responded to us, I had about 75 no's, or 75, either they say no or they just go quiet on you. The 15 that responded to us, I noticed that every one of them, somebody actually did a reference on our behalf. So you got to find who's going to do that reference for you, and make sure that that's the person that opens the door for you. On your own end, you then get into what problem are you trying to solve, how are you going to solve it, and what are your investment goals. Your investment goals are always important. What do you want to raise now? What do you want to raise later? How much of the company are you willing to give now, and how much of the company are you willing to give in the future? So next slide. Later on, I then discovered that every time I started pitching to the investors, I noticed that investors were excited about a couple of things on my pitch deck. And so I'm sure you already know that you should always have your pitch deck. And I'm not going to dwell on what the pitch deck should look like. You can research some of this. But there are some things that I noticed that the investors paid attention to every time I pitched, the 90 of them. The first thing was the team. The second thing was the team. The third time again was the team. And then you had market, idea, traction, the business model for scaling, and then the exit strategy. I did team because I want every entrepreneur to understand that. I noticed that number one team factor was that the investors were paying attention to what is the composition of this team, And do they have complementary skills for the business idea that they're trying to execute on? So, case in point, a Farmcrowdy. Farmcrowdy is both an agri-tech platform and a fintech platform. And so we do core operations, we do financial services, we do technology. And so the composition of the team of Farmcrowdy, they wanted to see somebody that had technology experience that was going to be complementing somebody else that had operations of experience, to complement somebody else that had financial experience, to complement somebody else that had marketing experience. The second thing on the team was the capacity and the competence to deliver on the work. So not just the team that has complementary experience of, oh, I'm a finance guy, he's a marketing guy, he's the operations guy, but we've done this for 5 years, for 10 years in our own capacity. And so the investors were paying attention to that. The third thing on team was, do they have chemistry between them? Do they have history? Or did they just come together for this idea? And so investors will pay attention to, oh, the two friends that were neighbors for a long time, and then they decided to try maybe 1 or 2 ideas before coming to this idea. They always love to see that. And so that's why I always tell entrepreneurs, do not find a co-founder because you just had an idea. The best co-founders that you see today were friends before the idea, and investors pay attention to that. The fourth thing is the market. How big is the market? I mean, Lagos today, is your business going to serve Lagos, or is it going to serve Nigeria, or is it going to serve Southern Africa and Western Africa, or is it going to serve Africa and Asia? Does the business idea, which is the fifth one, have the potential to be seeded to the point where it has a market that goes beyond your current geographical location? The sixth thing, which many entrepreneurs miss out on, is traction. And traction, from my own experience, has been just keeping the investor updated about what has happened in the first month to the second month, and how the business has grown from the second month to the third month, and what you've learned within that period. Traction is not always, you do not, in all honesty, and I heard Paul say this earlier on, in all honesty, investors like entrepreneurs with integrity. So as much as you want to sell and you want to market the good side of the business, they also want to understand what are the challenges you're dealing with. What are the risk factors, and how have you mitigated the risk factors to its barest minimum? So keeping track of the good things, you also have to keep track of the bad things and the ugly things, and show them how you should capacity to handle those things or deal with those issues when they come up. So keep track of your records from day 1 to day 30 to day 60 to day 90. You show how you've grown over time to express yourself in the business and show that you can handle the challenges that come upon. The seventh thing is a business model that has the potential to scale. I'll speak more to this on the next on another slide, which is around businesses that have high margins. But I'll talk more on that later. They also want to see an exit strategy. In deciding around an exit strategy, there are several exits that investors look at, whether it's an IPO or merger or acquisition/merger, or just this business becomes a cash cow and starts bringing in profit, or this business is going to continue to raise more money, where any investor is looking at an exit where, as you raise more money, they can cash out on their previous investment and move on to something else. So there are investors that are focused on, I want to be an angel investor, and by the time you're doing your Series B, I exit. Not because the business has exited, but because you've raised venture capital at that level, they're ready to sell the shares and move on. So you've got to have this in mind. You don't necessarily have to put this in your pitch deck, but you have to make the investor understand, either by presenting and speaking about it, that you have your exit plan. You can put your timelines down there on your deck, but show that investor that you're mindful of the fact that you want to make him a profit for his money coming into your platform. Next slide. Now, this is something I learned very recently, and I wanted to share, and it allows every entrepreneur to understand what stage their business is in, to know how they negotiate with an investor at each stage of the business, so that you do not have to waste time dealing with investors that are looking at a different level of the business, or focus on business on a different level, and you're on a different level and you're speaking to that investor. The create phase is when the idea is coming out and you're just trying out that paper to putting it into actual business, and then you're getting people on to believe in an idea. The investors you'll be talking to at this time will be doing very, very small checks. You're talking between $25,000, even $25,000 to $100,000. If you get an investor at the create phase doing $100,000, that's major chunk of your business that will go to that person. The release state is when you're launching, it's when you're bringing out the idea. If you notice from this J-curve, everything around the create, release, morph, and model state sits in the death state. It's almost like negative. You're trying out the idea. The release state is when you bring it out to the market to see how the market responds to your business idea. At that point in time, you're still talking to investors that are sitting around, the angel investor that's putting in a seed, or putting in the fund to get you going, or you're talking to a seeds-based investor that's just sitting here to get you off the ground. The morph state is where many startups end up dying, because in a morph state, what happens in the morph state is you've tried out something and you see that, oh, maybe there's some traction coming out of it, and but you've noticed that you may not be able to scale this and get to a point where you start making the decent margin very quickly. And so you want to try and keep trying and tweaking, and then changing the entire model to arrive at something that becomes a winning formula. Case in point is that there was a recent startup that did an IPO, Slack. And what happened with Slack was that originally Slack wasn't designed as Slack. Slack was designed as the team in Slack was building gaming application, but they noticed at some point that in designing their gaming application, they weren't getting the traction they wanted to get that would get them to the scale that was going to excite them. And they started looking at what else was working in the business. They noticed that the tool they were using to communicate with themselves was something that a lot of people were finding attractive in that business. That became an idea for them to morph into, moving away from gaming to now providing communication tools. And that has moved them to where they are today in their business. That is a classic case of a morph. And so businesses go through that morph stage. In a morph stage, you don't want to be raising a lot of money. You're still trying out your model. You don't want to raise too much money. I mean, if you have a lot of money in the bank, fantastic, good for you. But in Africa, in your morph state, if you're also going to be raising a lot of money at that stage, you'll be giving a lot of your business. And there are not even many investors that will be waiting for you to be morphing. They want to see at least the business get to the model stage where you can start raising a lot of money. At the model stage is where you've decided on what this business will actually be. You've seen something that works. You want to take it up to the next level. You want to get it to scale. You want to touch a lot of lives with it. You're done with the create release. You've done with the morph. You're not transforming this business to any other thing, but this is just a winning model that you're moving with. At that point in time is when you start looking at VCs, because VCs get excited about model and scale phase, where they know that their money coming in will just help you amplify a business model into other markets, which will give them a return for their investment. The scale phase is a classic VC stage, institutional investor stage, business stage for a business to start talking with institutional investors and venture capitalists. A scale phase is where you start targeting those venture capitalists that have huge pockets. Doing that in the morph phase is going to be a very frustrating process for a business. And then the harvest stage is where these investors start getting their monies back as you look at exiting. So you can go to the next slide. So all of these stages should inform what you should do per time with a business. Now, talking to investors, I've noticed that investors are interested in high margin businesses and high growth companies. In building your business model, the most attractive businesses are those that tick these 2 points for most investors. And I have come to see that irrespective of your location, if you can showcase your business to any investor where you can show high margins in the regions of 50% to 60%, those businesses become hugely attractive, especially also when it has a seed within it that has the potential to grow. And so in designing your business model, ensure that as an entrepreneur, you're able to showcase to an investor the ability for that business to have huge margins and the ability for it to scale. And whatever you have as a business in your business model that is not going to allow it to scale, You have to find a way to reducing that and focusing on the parts of your business that gives you the ability to scale. High margin businesses are huge, attractive. They are magnets. High margin, high growth companies are magnets for any investor. Pay attention to this as an entrepreneur as you move forward. So I just wanted to point that out. On the next slide, are your interests aligned with that of the investor? So you may be talking to an investor that is focused on impact, for instance, and all he's talking about is how you change the life of I'm using Farmcrowdy in this instance. You're talking to an investor that's talking about how he wants you to change the life of a farmer. And all his after is how much has the farmer made in return as a result of your business activity, or how much have you been able to boost food production within a particular location. That investor is an impact-driven investor. You shouldn't go to him with a strategy as you would to an investor that is focused on how do you scale this business? How do I grow my margins from point A to point B? How do you move from market to market? How do you grow the profit in the business and move from profits from a sense where I as an investor will be looking at exiting in the next 3 years. Different investors have different focus points. Make sure your goals are aligned with the goals of the investor. If you're impact-driven, grants are a better way of raising money. Long institutional investors are a better way of raising money. Institutional investors that are focused on impact, make sure you do your research on them so you don't waste time speaking to an impact investor when you should be speaking to an investor that is looking at exiting in the next 1 year with a quick win, an investor that's interested in e-commerce. So do your research around that. Is the market you are going for big enough? I just wanted to emphasize that again. On a personal level, is that the kind of business you want to grow? Now, this speaks to the qualities of the entrepreneur. Are you, with all the things you do in building your business or in all the things you've done in the past, do you have the personality traits to continue to sustain the business you're working with? Investors always identify that when you're having conversations with them. Next slide. Plan. Predict questions and outcomes ahead of time. And so one of the things I learned to do earlier on with investors was I highlighted all the possible questions that investors will ask me based on the conversations I had with previous investors. I highlighted the new questions that investors asked me today that I have not answered before. And I made sure I had the answers for these questions so that every time they ask me the similar question, it's just like going to an exam hall and you already know the answer to a question that you're going to be asked. You're able to present that. You also need to have your data room as extensive as you can get. And your data room, you can provide the answers to some of the questions as well. And when it gets too much for you to answer, you can refer an investor to your data room to answer more of the questions. Look for the best alternatives for a win-win scenario. And in this case, it's just reminding yourself that money isn't everything. There are investors that may give you little cash, but give you a lot in business development. There are investors that will give you a lot of cash and won't give you anything in business development, and you're left in the way to do things on your own. Make sure you're able to align yourself with an investor to know what value will this investor bring to the table beyond cash. It's always important as an entrepreneur, especially for a very, very early stage businesses. Having an investor that is able to have some time to advise you, to provide links for you, to do referrals for you, to look at the business and reduce the risk in your business for you. That is important in achieving with an investor. So in negotiating with such kind of investors, don't be too hard on the money. Take mentorship and value that as relationship capital as well. Know what you want to compromise on as well. I mean, you will know what, if you plan ahead and you know what you want to compromise on, by the time you're having conversations with the investor, you're as flexible as you want to be with them. And then you know what you can take and what you won't take. Next slide. Create optimal conditions for a good negotiation meeting with the investor and other parties. Always make sure that try to understand what your investor looks like, and in doing so, if you can identify a previous entrepreneur that they've invested in their startup, and you can reach out to that entrepreneur find out what this person is like, find out what makes him tick and what makes him spooky, find out what he will enjoy. I had an investor that I found out very early. He always loved to have green tea every time he had a meeting. So every time I want to have a meeting with that investor, there was always green tea available for him. I just had to put him in his zone. And that is just pretty much what you're going to do with your investors. In planning and understanding your investors, you make them get into their zone so that you can have some level of conversation at the level where, especially for very, very early investors, you want to have a relationship beyond the money relationship. You want to be able to create a rapport with them. Make sure you are meeting with the right people, the decision makers. Now, in this instance, the right people, because you can get into a VC company, you can get into venture capital, and there are a couple of people to meet in that table. And maybe there's a particular partner that's focused on your market. But you're speaking to another one that's focused on another market. You need to do your research to understand who you should be speaking to. Some associates are as important as the decision makers. If you can build a very good relationship with some associates in those firms, they will make a good case for you in presenting your business to the right stakeholders. And so make sure you're talking to those right people. The right people may be an associate now and then the decision maker tomorrow. And build rapport. In building rapport, the way I've gone about that is I consistently keep my investors updated. So I send monthly updates of all the activities happening in my company to potential investors that I want on my cap table, and to my current investors on my cap table, and to my advisors. I also provide updates to the team, which is the company. So in providing those updates, it continues to build rapport with those investors. Every time those updates get to the investor, the updates remind the investor about your company. The updates makes the investor, and you don't just send updates, you also give them tasks. You say, oh, I'm trying to do X, Y, and Z, and I would need you to please advise me on this and this based on these updates you're getting. Thorough updates that includes operational updates, technology updates, people updates, marketing updates, financial updates, all of these in one, and you give it to them on a monthly basis. It makes you build a rapport with the investor. Beyond that, also, it allows you to keep a potential investor abreast of the activities that are happening, to see the traction that's going on in the company. But do not give out your IPs because you're trying to build rapport. So as much as I give those updates, I'm not going to tell an investor, a potential investor, what makes my business tick when he's not yet in the business. So those are things I just wanted to point out. So next slide. I'll close the negotiation as quickly as possible. I have a friend of mine that he says he has a rule. I mean, he's raised over $20 million. He's in Nigeria. He's raised over $20 million at the moment, and his business is barely 2 years old. He has this fast rule that if you start having the third meeting with him, he's already backing out of the conversation. He likes to close his conversations within the first meeting and the second meeting of meeting the investors. I usually have a team that does my own due diligence, but we make sure as soon as we're having conversations with investors, I ask them questions like, what is your timeline? What is your average timeline for making deals? 1, 2, what is your portfolio size? How much are you ready to invest? 3 is, have you done any deal recently in the past? And so that all of this helps me in making my negotiations happen as fast as I can do them. And I do not over-negotiate. The longer it drags, the less likely it's going to close on an offer. Don't over-negotiate. The next slide, please. Build rapport the first time, the person, the product, the profit. But let's go to the next slide. In every experience you have with an investor, there is something to learn as an entrepreneur. You cannot take for granted those little meetings you have, whether they do a deal with you or not. The reason why I've learned how to do better with our pitch and negotiate better is because I've had 90 experiences with investors in my own time. And to every time I did a pitch to an investor, I got a no, I also can go back to the investor and ask, what happened? What was the deal breaker? What made you not do the deal with us? And so that I learn what to do better. But beyond that, as I'm having the conversations with them, I'm understanding clearly what what I need to do better the next time, how I need to present my business better the next time. I'm studying the body language of the investor to understand what is getting them excited per time and what is not getting them excited. So how do I deal with taking that off and then doing more of the things that gets them excited? And so don't get discouraged. You continue to pitch, you continue to pitch, you continue to pitch. And until one day you just get these guys excited and you start seeing that you become the grandmaster of pitching. The don'ts. Do not take, so apart from all the opposites of the do's, because this is my last slide, do not take for granted the term sheet. If you get to a point where an investor presents a term sheet to you, please get a very good lawyer to go look at that term sheet. You may not be able to pick up all the points. As little as I give you a case in point. This is not with Farmcrowdy, this is with a different business. An investor put a line on a term sheet. And they said, so I'll give you the example so you understand why you should do this. They said, we're going to invest, let me use for this example, $50,000 in your business, right? And they said, for the business development that will be done, we will do $50,000. And then there was a comma. And then there was another statement after that. Now, what happened at the end of the day was, what they said with one line, that document had about 5 sheets. But what they said with one line in that sheet was that they were going to do business development, and the business development wasn't defined. The business development was just purely traveling from point A to point B to have conversations with him. That's business development. And even if it was just 30 minutes, that was a business development because it wasn't defined. Now, for the business development, they were entitled to having shares in the business as though they raised $50,000. Meanwhile, for us as entrepreneurs, we thought that the $50,000 was going to be the yardstick for them having equity in our business. But we couldn't think of, we did see the comma, just a comma in between the lines to say that what they meant was that the business development was an important part of getting equity in the business as against the investment of cash. And so when that conversation got to lawyers, the lawyers looked at it and said, you know what? These guys are right because you didn't read this line properly. And at that point in time, I knew that, see, the term sheet, when you're signing those term sheets, it's very important to get a third eye, a fourth eye, get a lawyer to look at it and understand exactly what those terms are. There's some investors that will invest in you today, and there's a term that says they're not going to dilute their shares in your next 3 rounds. What you've pretty much done is you've sold more than you've given in the first place of signing that investor. And people don't pay attention to this as entrepreneurs. You just get excited of, oh, I've raised a lot of money now. But truly speaking, you've actually sold off more than you bargained for your business. These are the don'ts. Make sure you get a third and fourth eye lawyer to look at your term sheet. The last don't I would say is, when an investor says no the first time to you, it doesn't mean that if you get that business up and running, you take that feedback and you do what you were supposed to do to get it to a place where it becomes a better business after a 6-month or 1 year period. You do not need to tell yourself that you can't go back to that investor. That investor will be interested in you again if you're able to meet up with what they said no to the first time. So don't close the door to an investor that says no the first time. If you feel you've built traction, if you feel you've built a model that will still be attractive to that guy, go back to them and keep giving them updates. All right, so I think that's my time. I will be happy to answer as many questions as will come up. But those are my points based on what I've said in negotiating with investors.
Well, that's a second mouthful. I think we're having a full meal here today between Pol and Onyeka. Thank you very much. I mean, that practical reflection, of course, is exactly what guides us and helps us. So I got a few very important points raised from you. But I was wondering before we ask Alex just to give us a summary of what's been happening in the text chat. And we'll try to address some of the questions in the Q&A too. We may not be able to get to all of them, I'm sorry, if we have to skip anyone's question. But before we get into that, Onyeka, if I would ask you, what is the biggest mistake you made in negotiating with potential investors? And in hindsight, what is the wisest step that you took in that process? Those two elements.
The biggest mistake I made was not going through the term sheet. At a point when I got to the term sheet, and I mean, it cost me 10% of my company because I did not see a comma in the term sheet that changed the table from an investor doing a deal or not doing a deal the way I wanted it done. And that was a big mistake. Now, talking about, at that point in time, we just had one lawyer that helped us register the company. We didn't even pay attention so much to lawyers. Today, in my business today, I have 5 lawyers. I have a lawyer that focuses on investor relations because they're experienced in that. I have a lawyer that focuses on litigation. I have a lawyer that focuses on business. And so I have a lot of lawyers that I'm able to now get counsel from, so if a term sheet is coming to us today, there are 3 different lawyers from 3 different parts of the world that will look at it and make sure that everything is exactly the way it's supposed to be. That was the biggest mistake that I made in having a conversation.
You won't make that mistake again, I assume.
No way. Yeah.
You can smile a bit about it, at least at this point in time. But and if you, in hindsight, a clever step that you just naturally took.
Sorry, I didn't get that.
Something that you did that worked out very well. Some clever step that you took. In hindsight, it looks like a very great thing that you did without actually knowing it at the point in time.
It was the updates. Now, people don't give updates to potential investors. They only give updates to their current investors. But I've found out that as soon as you start having conversation with an investor, they've at least showed interest. They've not said a yes that they want to do a deal, but at least they've had conversation and asked 1 or 2 questions. I started giving them access to at least a brief version of my in-depth update that I sent to my stakeholders. And I noticed that because I was keeping them in the loop of the business, even if they don't do a deal, they started doing referrals, they started doing introductions, and then they started opening up more opportunities for me. For some of them, eventually, over maybe a 1-year period, they eventually did a deal with us. That, in hindsight, has been one of the things I consistently tell you. It's not easy for an entrepreneur to be running a business and then you have to sit down and start gathering all the updates and putting it together and sending it to investors. But that has been a very, very good resource for me in hindsight.
Great. So let's have a bit of a discussion, if we may. So Alex, maybe start with you. So you've been keeping an eye on the text chat. Have you picked up something there that we need to address that we can ask Pol and Onyeka to comment about?
Okay, yes. So we have a lot of interesting questions that came up in the chat and also in the Q&A section. So one of the interesting questions that I'd like Onyeka to answer actually came from Jude. And he asked a question: how best do investees protect their trade secrets and their intellectual property when negotiating with investors? Because you're disclosing a lot of information. How do you protect yourself in that process? And Pol also can chime into this as well.
Okay. I hear a lot of investors that say they don't sign NDAs, and I don't think, I think it's the case that many investors don't sign NDAs. So it's difficult to get them to sign NDAs. But if you find an investor that's ready to sign an NDA, fantastic. That's a good way to start. But beyond that is, I always say to entrepreneurs that if you have a business that has an IP, I mean, if you have a pure IP, it already protects your business idea to a great extent. But if you have a business that you're just trying out and you're already calling it an IP, and maybe there are 3 other people that are doing the same thing in another market, what are you really IP? At the end of the day, you want to be able to show as much as you can show to an investor to convince them that you're the right deal. Do a little with your pitch deck and then get to the meeting where you have conversations with them. So this is my own approach. The pitch deck is the appetizer. It lets the investor understand that this is what I want to do, this is what I'm doing, this is what I've done. I'm looking at doing X, Y, and Z. So as much as that investor decides to share that pitch deck across the world. I'm not bothered because I've not said so much about what makes my business really tick, even if I've identified some things in my business model. When I then get into the meeting to have in-depth conversation with that investor, then I can share a lot more about what makes my business tick. However, by the time I get to the point of exposing the investor to my data room, then there needs to be some legal binding around how we share data, and then they start getting into understanding that we may need to get to the NDA level. But when an investor is getting to the point of getting to your data room level, it means that investor is making a bigger commitment to doing a deal, and you're almost 50% done with that. I don't know if Paul may have something.
Paul, do you have something to add there?
Yeah, well, as just said, you know, for me, I signed a zillion NDAs in my life, yeah, a zillion. And it's within 2 years from now, I will be 50 years in business, 50. And I never, ever had, you know, something going to court because of a breach of an NDA or something like that. Never, ever, yeah. So for me, it's not important. If somebody wants me to sign an NDA, fine, I'll sign it. Of course, I will read it. You know, every legal text you need to read. Yeah. But protection of IP as much as you can. But real protection of IP is costing lots of money, and actually you're just looking for money to pay for that. Yeah. So if you have at least your own URLs, you know, that is your business, presenting your business, and then secondly, perhaps have protected your name, your trade name, yeah, and then if you have some money to do that, you know, having patent pending of some things, but you know, usually businesses or startups do not have the money even to pay for that.
Yeah.
Okay, so I must apologize to everyone that has posted questions. We're definitely not going to get to all the questions, and some already had to go because we are over the 90 minutes that we promised already. But Alex, perhaps, or Onyeka or Paul, if there's a question that have attracted your attention, maybe we can focus on that too. So I'm not sure if there's another one, Alex, that you would like us to focus on?
Just a brief one that came from Laura. So I know that both Paul and Onyeka emphasize that when you're meeting with investors that you have a strong team. So Laura asked that if you're like a startup and you don't necessarily have the large, strong team yet, should you still go to investors to look for funding, or should you wait till you have a strong team before you start looking for investment at all?
Okay.
Onyeka, shall I answer, or will you?
Oh, yes,
Paul, go ahead.
Okay.
Go ahead.
Well, then, of course, being a startup and going for money, you don't have, usually you don't have the money to pay for a large team or even for a team as such. What is actually a good thing is to have several people that are willing to join and are even on the side to help you to create your business. Yeah. And the first thing in due diligence I'm doing when I see that is actually if they have kind of a contract that when there is enough money, yeah, they will join the team. So that's actually something that then I like. I understand, you know, with negotiating with potential investees that they don't have the money to pay somebody full time, but if they have contract with all the people they put on the team, that once the money is there, they can join, they will join definitely. That's something I would look for.
Yes, that's a very good point. We did that. I did that also in Farmcrowdy. My CFO, I couldn't afford him. My co-founder and CFO. My CTO is the same thing. As soon as we raised money, they came on board fully. So I think that's a good point. I'm seeing a couple of more questions here.
Is there something that is catching your eye? So by the way, if we are not getting to your question, there's Paul did indicate there that from the HWeb side, you know, sort of Page's email address, we pasted there in the chat. You can make contact with Page if you do feel that the HWeb may be able to support you. If you have questions that you are addressing specifically in preparing for funding round, There may be ways that we can help you specifically around your questions if we're not answering them here today. So Onyeka, is there a question that's catching your eye?
Yeah, so Israel Mwalyaje said, can we get a list of contacts of mails for investors? So there are a couple of lists out there, but I think the most effective way, you can have a list and then but you need intros. You need intros to those people. If you do cold calls, many of the times it doesn't work. So there are a couple of lists out there. I can share some with you. Depends also on the sector you're looking at. The way I built my list was I went on LinkedIn and I started searching. I went on Crunchbase, I started searching. I went on VC for Africa, I started searching. And I built my own list of investors. So depending on your sector, you may want to build your own list. And then you also look at on Crunchbase, for instance, based on my sector, I look for somebody that has raised an investment in my sector. I look at his list of investors and I create my own list from that list. That's another way you go around it.
So again, it gets back to that point that both you and Paul has been raising over and over. I think the word that has been used most in this masterclass is the word research. So get their information, but it's not only, if I hear you right, Onyeka, it's not only about the list, it's about the referral. So the best bet is if you can find someone that knows the person in that fund that you've identified. And LinkedIn is great at that, right? It actually shows you who you connected with that may be connected with others.
Yeah. Someone said, okay, Paul.
Paul?
Absolutely. I mean, Onyeka, you're right on the point there. I've done myself a lot of cold calls and got in actually in my past when I was begging for money. And I'm sure Onyeka, and by the way, your story is very inspiring for me. I loved it.
Thank you.
But if you contacted 90 potential investors, you did lots of calls before you got to the 90. But if you have somebody that knows one of those guys, it's always the best thing to go on. Yeah, you're very right in that.
Yeah.
Shall we do a last question? Alex, is the one that you have identified?
I actually wanted to ask if somebody wanted to raise their hand if they wanted to speak. Can we do that?
We can bring someone in the room quickly if you want to. I see there are a few attendees add to. Okpo, do you want to join us?
Zion would like to join. Should I let him in?
Okay, I've got one hand up.
We'll have Joshua as well.
Joshua too. Let's just see who's in first.
I don't know. Who's first?
Who's joined us?
Okay, Zion.
Turn your camera and your microphone, and you can speak.
Hello. Can you hear me?
Yes, we can hear you.
Yeah, we can hear you.
Who's speaking now?
All right, so I'm actually listening from my school here in Ojeba. So my question is, my business is set up such that is kind of a social impact and also like a business. It's a social impact, but with potential for profit if I scale up. Like, we already have 111 children. My question basically is, how do you approach investors when it's seeming to them like what you're doing is charity more than what you're doing is more a business. It's a business, but it's a social impact project / a business. So if I get more children paying 4,000 naira, which is the fee I charge for education, I'm going to be making profit and then doing good at the same time. So how do I attract investors? How do I meet people that are in this line also to help me leverage on technology to scale up? I think Farmcrowdy is using technology a lot. So for us, people like us that are maybe in Warri, and then we are not maybe in the busy cities like Lagos, what do we do to attract investors and, technology people like in our sector? How did Farmcrowdy and you guys, how did you attract people in your sector? So I just want to know how I can do that using my model as a social impact person, who have not really scaled up yet. I'm just at the verge of it.
Okay, great. Thank you. So social enterprise, is it different from other enterprise in raising funds and connecting with investors?
No, it's not. I think the way I see it is this. One is, you mentioned very clearly that Farmcrowdy has used technology. We're social entrepreneurs as well, if you put us in that light. But the difference is that we've used technology to turn that into a business. To every investor that is putting their money in your platform, they want to get something out for it. Is either so you got to focus on investors that are either tied to the profit or they're tied to the impact. And once you decide which one it is, so for instance, the question you just asked, you have a social enterprise that focuses on child education at a very granular level. Now, the biggest thing you can do in that regard is to look for two things. I mean, just looking at that business now, there are two things you need. One is you need to find a way of using technology to amplify your effort. Technology is no respecter of location. So it's not because we're in Lagos that we're different from the guy in Warri. If you design a technology platform that is able to do the same thing you're doing at a bigger scale, where at the entry point, maybe for SMS service or USSD codes, people are able to also get the same service that you're rendering to those children, or the children are able to access what you're doing, or you're able to amplify your efforts to, rather than one teacher to 10 children, you use one teacher using the device to amplify the effort to 1,000 children. Once you're able to design your technology to use your same efforts today to reach more people, you can now start using that to showcase to impact-focused investors. And there are many of them. There are many investors that will be happy to invest in you as grants that will not even want equity, but will tie you to major KPIs of achieving the same goals you're doing at a bigger scale. But they'll only be interested if there's a way of amplifying your effort with technology. Two is find team members that will do pro bono with you, that will provide their service either with technology or with the trainings you're doing at a level where they don't want you to pay them for it right now. They can be in Lagos, they can be in Abuja, they can be outside the country. They're just excited about the fact that you're doing this with children and providing education for children, and they will provide that service for you at no fee initially. If you do your research, you will find these people, they exist today. And that's how we got going with ourselves until we started raising money to start funding our scale.
Great. Yeah. So shall we do a last question with Joshua? Joshua, what's your question? And then we can ask Paige and Alex perhaps to just give us a quick rundown of how people can connect with both the HWeb Foundation and the Tony Elimele Foundations. So Joshua, what is your question?
Yeah, I think he started to answer it towards the end there. My question was around co-founder. So my biggest thing is I don't have a technical background, so I'm self-taught. And I was developing a streaming platform centric around helping artists go to market and helping users discover and curate content based on their social persona. So I wanted to develop this thing, so I started teaching myself how to code, but it's stealing away from a lot of other things, such as business development. And I wanted to know what's the best way to find a co-founder, but when your when your current relationships or where you're from right now isn't that tech savvy. So I'm from Botswana right now, and the technical skill base is not that good. So if you're looking to get a co-founder that's a long-term relationship, what's a great way of finding people outside when you haven't had that first impression with them? Because usually with a co-founder, it's not always about their skill base, but it's also about their, their personality and, things that don't really surface if you haven't met the person face to face. So what's the best way to find a co-founder that you haven't met?
You've just done it. That's a short answer.
Yeah.
I'm not sure, Paul, if you want to add something there, but that's the start, if you don't ask, you don't get.
Now, I have quite a bit of experience working with a co-founder, the business I was describing in my presentation that reached $8 billion of market cap and more than 8,000 people, 32 countries, etc. We started with 2 people, with a co-founder, and I have many cases where that didn't work, and it's quite difficult, you know. More businesses fail because there's a fight between the founders than for something else. So that means finding a co-founder is fine, but it's something you need to put lots of time in. And my advice would be, you know, to advertise digitally, you know, that you are looking for a co-founder, just like you would hire somebody, yeah, and then doing interviews, etc. And the most important thing, besides, you know, the talents they need to have and the experience they need to have, the most important thing is that your characters match, yeah, and that your goals match. The first thing I did with my co-founder, yeah, we spent a long weekend together, yeah, starting with what do you want to achieve in life, yeah, what are your life goals, what are your social goals, yeah, etc. And then from there, starting to wind down to actually how would we together start up this business. And as Onyeka said, you know, exit, discussing the potential exit as well. From the beginning on, we discussed, you know, we want to go public, and we want to go public on the Nasdaq, yeah, which was the first in Belgium. We were the first Belgian company going on the Nasdaq. But we can hold a separate seminar about what you're asking for.
Yeah, so team is clearly, it stands out, you know, sort of it was point 1, 2, and 3 on Onyeka's priority.
Absolutely.
We spoke about financial plans and so on, you know, sort of 2. So there are lots of topics for us to pursue in future masterclasses, and that's a promise. We will be back here next month with another topic. So I must thank Pol and Onyeka for their inputs today. So rich. So we will have the recording. We will distribute the link so you can actually rewatch it if you want to. But let's just end this webinar off by asking Paige and Alexandria to just share with us developments within the 2 organizations. And I'm putting up the links there to our websites so that you can go there if you need to. But Paige, can you start off what's up at the HWeb and how can people connect with you?
So at the HWeb, we have the foundation side, which supports entrepreneurs as well as supporters of entrepreneurs. So we have a few programs that we're running. So if you're interested in anything about that, you can contact me. And then we also have the fund side, which I'm sure a lot of you are interested in. And for that, we have an online application system. So I'll also place the link there. And if you want to get in touch with us and show us your pitch deck and talk to us about it, then you can go through to there. Also can contact me via my email. So I'll just post that stuff there now.
Yeah, and if there are questions that we couldn't answer that you think we can, that the HWeb can, perhaps there's a way for them to connect with you on the email too, their page.
Yeah, sure.
Great. And I see Alexandria's pasted her email address there. So Alexandria, Tony Elimele Foundation, I know you're very busy with alumni right now, moving into an event.
Yes, so I've just posted my email address in the chat box there. But yeah, at the foundation, we're quite busy. We have a number of initiatives that we're working on currently. So next week, we'll be having our TF Forum, which is going to be taking place in Abuja. It's going to be a gathering of African entrepreneurs from across the continent, and also a gathering of all of the major stakeholders within the entrepreneurship ecosystem. If you're interested in attending, I've put my email address so you can send me an email and we can get you registered to attend. We also have our ongoing entrepreneurship program that runs each year where we fund, train, and mentor 1,000 entrepreneurs each year. That application will open up in January. So right after the forum, we're going to start promoting the next cohort to bring in the next cohort onto our program. And we also have recently launched in partnership with UNDP, another entrepreneurship program that is reaching the areas in the Sahel and the Lake Chad region, where we're trying to share our training and our funding and our mentorship with entrepreneurs that are in vulnerable areas. So those are the 3 things that we're working on right now. If you have any questions, if you would like to learn more, about what we're doing at the foundation, please send me an email. Yeah.
Yeah, no, great. Thanks, guys. It was a really informative. I feel a bit overwhelmed, in fact, about all the insights that were shared. But go out and apply some of that in your process in engaging, and I'm sure you're going to have good results. I was a bit intimidated by that 500 to 90 to 50 conversion rate that Onyeka spoke about. But I suppose that's part of the game, you know, sort of to research and find the right ones so that you can move forward in connecting with the investors that is most aligned to you. So best of luck. Do the research, do the planning, and execute. And then let's build those businesses into impactful enterprises. Have a good day, everyone.
Thank you.
And see you next month.